I guarantee by the end of this YouTube video, you're gonna master support and resistance. In fact, if you can become proficient at just this alone, you can become profitable and have a positive expectancy on your account. There are traders right now, today, that are exclusively using support and resistance in their trading, and they're making an absolute killing. So if you're looking to learn how to use support and resistance and supply and demand, then you're in the right place. So let's go ahead and get started. Essentially, all a support and resistance area is, it's an area on the chart where price, if it ends up reaching it, it stops and then it reverses. If it reaches that same area again, it then stops and reverses. And if it reaches that area again, it stops and then reverses. And it's important where on the actual chart that it turned that U-turn or reversed, because that will help you identify whether it's a support or a resistance area. So whenever you're talking or thinking about a resistance area, the price is stopping and reversing towards the top of a trading range. So this right here would be considered a resistance area. You can kind of think of resistance as a ceiling. Now, if the price ends up reversing towards the bottom of a trading range, these lows over here, this would be what's called a support. Think of it like the floor is like supporting you as you walk. So the bottom is usually called a support and the top ones are what's called a resistance. And these generally happen at any specific price point on the chart. So if you look at this chart over here, this resistance area that I've drawn over here, look to the right, you kind of see like the price over here. This rejection area was around 1.35721. The price is resisting and preventing itself from going any further higher. Now, this bottom one over here is what we call a support, and the support is 1.34136, somewhere in that general area, and it's preventing itself from going even further down below. So I'll go ahead and just kind of notate and mark out these little zones for you. And this bottom one here would kind of look just like this. Now, the question is, why do these zones even occur? So for example, why does a resistance area even occur? And it is because at this point, supply is exceeding demand. There's way too much supply in the market at this specific price point, and there are a lot of sellers waiting in queue, have their sell positions ready and armed to enter a trade in the down direction, or in other words, to enter a short. So it's a combination of brand new sellers entering the market looking for sells, and it's also a combination of the people who had previously bought. Let's say you bought over here, and you're looking to close your trade, you're trying to figure out where should I close my trade, and you ask yourself, okay, if the price previously struggled to breach this area, is it a higher probability that the price might react and turn another U-turn here? Or is it a higher probability that the price is going to pierce through it and then end up reversing somewhere up here? Logically, it is a safer bet to take your profits, to close the trade at an area where the price had a struggle in the past. So buyers that were once in the trade are looking to exit their trades, or looking to sell off their buys, and then brand new sellers are entering the market. Brand new traders that are entering shorts, looking for a short position, are entering their sells in the same exact area to then later on buy back what they sold for a short. So in this case, they're selling high to then later buy low. So the question is, why do these support areas form? It's the same type of concept, but it's a little bit different. I want you to imagine that there's a lot of buying pressure right here. What do I mean by this? I mean, there's a lot of demand in this area, or in other words, there's a lot of demand at this price point, a lot of buyers in the market looking to purchase at this specific price. And that is generating a lot of demand, which is pushing the price higher. Let me give you an example. Think about whenever like the PlayStation 5 first came out. I don't know if you guys know much about it, but it was very hard to get a hold of. Sony didn't make a lot of PS5s and it didn't meet the demand. So what ended up happening, every time the PlayStations were at a store, Walmart or anywhere, they were always being sold out. People would always buy them and it will always be sold out. So it was super hard to get a hold of that. So what ended up happening, scalpers ended up realizing this and they ended up buying PS5s as soon as they hit the market. They started buying them online on all the different stores, all the different retail places, and they bought the PS5s because they knew the demand was so high. So many people wanted to get their hands on a PS5, but they couldn't. And because all these scalpers, all these different people had excess PS5s at their house, they're looking to sell those at additional profit. So that caused the prices of the PlayStation 5s to rise. So even though the retail MSRP of a PS5 is like $500, $600, people were selling these consoles on Craigslist or even eBay or even Facebook Marketplace at $1,000 or $1,200 or even $1,400, $1,500 or even $2,000 just because people wanted it so badly. Same exact concept. Think about it. People are willing to buy a PlayStation 5 for, let's say, $500, $600 where the price is, but if they don't have any available, the next person will be willing to buy it for like $650. The next person is going to be willing to buy it for like $700 because they want it so bad. And if the sellers notice this, they're going to keep racking up the price a little bit higher because they know people are going to continue to buy it until the supply and demand has equilibrium. So how do we know whether a supply or demand area, a support and resistance area, is reliable? How do we know the next time the price approaches it, whether the price is going to bounce off of it or whether it's going to completely pierce through it? And one way you can help yourself determine whether a support or resistance area is going to hold is to see if that same price point has been holding in the past. For example, if you see 1, 2, maybe 3 times the price tried to pierce that area, that can signal a potentially significant resistance area where the price might reject again at another time. This is what's considered a strong resistance area. Same exact concept for a support area. If the price has been rejecting or reacting around maybe 3 times or more, that's kind of when you know it's a strong support area as well, and it has a probability of reacting in the same area the next time the price comes around. Now, what you have to understand is that in trading, nothing is 100%. None of these zones or nothing that you do in the market is going to give you a 100% win rate. That's not the point. The point is to give yourself an edge in the market. As long as you can get trades right more often than not, give yourself a higher than 50% win rate, you know you'll be able to make money in the long run. Too many traders get focused or sidetracked on getting the highest win rate, but at the end of the day, as long as you have a positive expectancy, as long as your risk to reward ratio is greater than 1, you'll be able to grow your account indefinitely. So what you're looking for is you're just looking for an edge, and these support and resistance areas, these supply and demand zones, will be able to help you get that edge in your trading. Now, the next thing I want to talk about is a lot of people, whenever they're doing support and resistance, they draw their support and resistance as straight up lines, and it's not a line. So I see people all the time drawing a resistance like that, or they're drawing a support just like this, and this is what they're using to enter their trade, a simple line. But that is the wrong way. That is the incorrect way to do support and resistance. Instead, whenever you're identifying support and resistance, you want to draw these areas as zones. Let me give you an example. So this is how I will draw this support and resistance area. Let me go ahead and delete that line. And then this is how I would draw this support and resistance area way down here. Now the question is why? What's the point of drawing these areas as zones? It's because price isn't going to magically reverse at a single specific price point. It's always going to be somewhere near or around that area. So let me give an example. You can often see price action doing something just like this. It'll move up, it'll go down, it'll move up, it'll go down, it'll move up, it'll go down, up and down, and it's never really going to be like super perfect. So let's say someone drew their resistance just like this, or they drew their support just like this. And if whenever the price approached this area, for example, let's say the price was approaching this resistance area right over here, if they had only drawn just a line, let's say they would have entered their sell, their short position right over here, and had their stop loss above the line and their take profit down here. And because they didn't consider it an actual zone, because they entered their short here, they're looking to sell on this position here, but because they were entering on the line, they got stopped out, or the market hit their stop loss, and then it continued to go in the direction. I don't know if you guys have ever experienced something like this, and it's a very common thing that happens in the trading world. So instead, the way we need to do this is we need to draw this as an actual zone, knowing that the stop loss must be above this area. And I'll get into the specifics of how high it could be above this area, but you at least want to be able to encapsulate this entire zone. Now, same thing with the support. You would want to draw your support and encapsulate the entire zone itself. And by doing so, by drawing it as an actual zone, it's going to allow you to give yourself a bigger buffer to not get stopped out unintentionally. So let's go ahead and look at some examples on an actual chart. So right over here, we can see the price has had trouble breaching this area. So how would we draw this zone? We want to make sure that we want to try to attempt to encapsulate all the way to the very tip top of the zone. I'm looking at this little area over here. This is the highest that the price went to. And I want to try to keep this zone as thin as I possibly can while attempting to capture as many points as possible. Now, if we get the measuring tool, we can even see that this zone is roughly around how many pips? It's around 30 pips deep is how wide this zone is. So pretty thin, pretty decent. So let's go ahead and do a few more examples. Another support area I can kind of see right here. This would be a decent support area. I'm actually going to stretch this out a little bit further just to encapsulate this area over here. Now this next zone right here, I see two highs. This would be considered a zone, but I wouldn't consider this as strong of a zone as compared to this. This one has a lot more weight. This one has a lot more significance. And right here, this can be considered a support area as well. And what I don't want to see is I don't want to see anyone drawing zones in like areas like these. For example, let's say you see the price is like reacting, rejecting, and it's like having like a choppy area just like this. I don't want you to draw like a support area thinking that this is like a proper support, because it's not. This is someone trying to like stretch it. This one's someone like pushing it way too hard to make this zone fit. So whenever you're looking to identify support and resistance areas, you want to try to find the easiest, most extreme highs or extreme lows. Just the easier or simpler it is to find. I'm just going to use this tool here. It's a clear low, clear high in the same area, clear low in the same area. Price gets a little bit choppy in this area, price gets a little bit choppy, and then it's a clear high in the same area, and then it's rejecting again clearly in the same area. That's how you know you have found good support and resistance areas. Now, if you ever encounter something like this, let's say the price had trouble breaching this area just like one time, maybe it hasn't happened multiple times, you can definitely consider this a zone as well, but just know it is not as strong, it is not as significant. So the chances or the probabilities that the price might react in this area in the future, again, are lower than something like this. Again, remember, trading is all about probabilities. You want to be able to give yourself an edge in the markets, and these stronger and more significant zones are going to be the ones that are going to be holding more often than not. Now, the next thing we do need to discuss is whenever you're drawing a zone like this, or any zone in particular, you want to make sure that you always stretch it out. You want to draw it farther than the current price action. If the current price is right here, you want to make sure that you draw your zones past it into the future. Why? Because this zone is useless if it ends over here, because we're using these as guidelines of where the price might react in the future. So if I drew my zone and ended it way back here, and if the price ends up coming back up, let's say way up here on like some later date way in the future, if that zone is not clearly visible in front of my face, then I'm not going to know to potentially enter a sell position. So what you must do is you must make sure you stretch your zones into the future. Because again, these are going to be what's called guidelines for the future trades. So now what happens in a scenario where a support zone or resistance zone was being respected, but let's say the recent price action just started being super sloppy in that area? What you can do is from this point forward, it is going to be a very risky zone to enter your trade in. So at this point, you can just kind of stop that zone and end it in that area right over there. But if for whatever reason you did decide to use that zone as a marker point in the future, just know that the probability is going to be a lot lower than something like this. This is a lot more cleaner and stronger zone. So in this case, I could just end the zone just right over here in this area. Now, the next thing that you must know, whenever you're looking at a support and resistance zone, it can turn into the opposite. Let me kind of explain what I mean. So if you're looking at an area that is a support zone, you kind of see the prices being supported in this area, and it's being supported in this area. What can happen is if this support zone ends up breaking, or the price ends up piercing through it to the downside, what can happen more often than not, if the price ends up approaching that area again, but from the bottom this time, is a higher probability of reacting at that area and creating what's called a resistance. So my point is, these support and resistance areas can turn from support to resistance, or can turn from resistance to support. So for example, let's say you had drawn your support zone just like this, and obviously let's say you extended it to the future. Let's say this is like the future over here, and you notice the price pierced it. As long as you extend it into the future, if the price ends up approaching it again, it is usually an area where you can enter a potential sell because now this support has turned into a resistance area. Let me give you an example. So you notice right over here, this point was at one point a support. And then what happened to the same exact zone? The same exact zone ended up turning into a resistance. I don't want to clutter the screen up too much, but notice that the price was reacting many times at this bottom area, and then whenever the price approached it a second time, it started rejecting this same exact area. So this support turned into a resistance. The same thing can happen the opposite way. So it can happen vice versa as well. So let me give an example. So this area right over here at one point was a resistance, and at one point turned into a support, and then at one point turned back into a resistance. So this is a strong key level that might be important to watch out for. So the question is, how do we actually enter trades on these zones? So let me go ahead and erase all this stuff over here. Just make it super simple. We'll just use this one area right over here. So let's just go ahead and use this one simple zone. I'll just extend this right here so it's one massive zone. So how we would use this is, let's say we have marked up our support that ended up turning into a resistance. We can kind of eye this area for whenever the price approaches this area next time. This can be an area where we want to enter a potential sell. So what we can do is we can enter what's called a sell limit, a potential sell pending order, where if the market approaches this price point somewhere in this zone, 1.36447 in this scenario, if the market touches this exact price point, we can trigger our trading platform to automatically enter ourselves into a sell automatically without any human interaction whenever the price approaches this area. Now, just know a few things. Looking at this zone, there's a few different probabilities and a few different ways that you can enter in on a zone. Just know that the closer that you put your trade on the closer side to the price action, notice the price is coming from the bottom and approaching from the bottom going up. The closer that you put your trade to the bottom of it, the higher probability that that trade will activate and the price won't turn a U-turn and reject without you. Has a higher probability of actually hitting your trade versus if you have a little bit more conservative entry. Let's say you put your sell limit towards the higher echelon, the higher bound of this zone. This will give you a lower probability that the price might hit your entry and then reverse. So you have a higher chance of that trade being missed. So you have a higher probability of your trade being activated down here. You have a higher probability of the trade being missed down here. But now the question is, why would anyone want to enter their trade back here versus down here? You might be thinking to yourself, oh, wow, I'm always going to enter my trade way down here. But the reason why that might not be as ideal every single time, and it all depends on your specific risk tolerance, the reason why it might not be ideal is because, remember, we're going to have to make sure our stop loss is always above the zone. So in this scenario, we have a much larger stop loss. Therefore, our risk to reward ratio is dwindling. On the other hand, let's say we moved our entry and kept everything else the same. Let's say we moved our entry to like up here. Our stop loss and our take profit is the same. The only thing we changed was our entry. We have a much greater risk to reward ratio with the stop loss and the take profit being the exact same. Nothing was changed. So scenario A gives you more entries, but a little bit worse of a risk to reward ratio, whereas scenario B gives you less entries being activated, but it gives you a lot better risk to reward ratio. So now you need to do a self-assessment and see which of these that you want to do. And in fact, there's nothing preventing you from entering somewhere in the middle. You can enter anywhere within this zone, and it's all based on your risk appetite. So now that we know where we can enter into the zone, the next question people usually ask is like, okay, where exactly do I put the stop loss? How do I calculate where I need to put the stop loss in the first place? You mentioned an arbitrary number just past the zone, but the question is exactly where do we put it? So there's a few ways you can kind of identify your stop loss. One way you can do this is you can open up an indicator, what's called the average true range, the ATR indicator. Essentially what this does, and I'll pull it up. Essentially what this indicator does, it tells you the average amount of volatility that a certain pair is having on the specific time frame that you're looking at. So right now I'm on USD CAD. I'm on the 4-hour chart. This will tell you on average what is the volatility of every single candle. So you look at this number over here. This kind of tells you the number of pips of volatility. Notice as I hover my mouse over the chart, this is going to tell me at this point what the volatility was, or in other words, what the average true range was. The average range or tallness of the candles was around 34 pips around this time. If you move it over here, it was around 29 pips or 30 pips. Or if I move it off the charts, just like somewhere to the right, it'll give you the current candle's ATR, which is around 30 pips. You can kind of ignore that last decimal figure. That's called a pipette, but in terms of pips, it's called 30 pips. So what you can do to be super specific and give yourself a rules-based approach, you can put your stop loss at a multiple of the ATR. So for example, you can do your stop loss of 1x of the ATR. Or if you're a little bit more conservative, you can do a different multiple. You can even do 2x of the ATR. If you decided to do your stop loss at 2x of the ATR, you would have a stop loss of around 60 pips. So we know first, our stop loss must be past the zone. So now we will count 30 pips or 60 pips from the edge of this zone. So this right here is going to give us a 30 pip stop loss. So now we know where our stop loss is going to be. If we were using a 2x multiple of the ATR, our stop loss would be around 60 pips. It would be right over here. Now that we have our stop loss set, now we can ask ourselves, where do we want to enter? We want to enter down here, we want to enter up here, or somewhere in the middle. Notice that the stop loss distance changes based on where I actually drag the actual trade itself. If I trade down here, now we have a stop loss of 91. However, we know, because we've already calculated it, that the stop loss is 60 pips from the far side of the zone. And that is what is important. And now, as the price action continues and the price action continues to play out, we have our entry set, we have our stop loss set, we have everything set, and you can adjust your take profit to the next zone or any other way that you want to do your take profit. I have videos on my channel showing you different ways you can take profit, and I'll link that video right above my head, and I'll put it in the description or the link below or whatever, so you can kind of check that out as well. So let's say we had our take profit over here. We can go ahead and allow the market to continue to play. We gave ourselves enough buffer. We have a decent entry, and then now the price hit take profit. If we had our entry back here, we would have had a much better risk to reward ratio. Notice this is now a 5.3 risk to reward ratio, whereas this right here is only a 3 risk to reward ratio. However, if we would have had our entry over here, this would have been just simply a missed trade, even though we would have gotten a better risk to reward ratio. Now, real quick, let's say the price ended up breaching this resistance area in the future. We can use the same exact zone to enter a potential buy. So how would we do that? Very simple, same exact concept. We would want to enter a buy position. We want to calculate the ATR from the farther end of the actual zone. So if the ATR at that point was like 26 or 27 pips, this is where our stop loss would be. And then we kind of adjust where we want to put our entry in that zone. And then whenever the price ends up approaching our entry, the trade will get activated, and then hopefully, if luck is on our side, we would be in a positive trade in profit. Now, the only way you're going to be able to master support and resistance, supply and demand, is by actually practicing yourself. One thing I don't want you to do is watch my videos on YouTube or watch anyone else's videos on YouTube and just think that you're binge watching Netflix. You need to actually pause the video, go to your charts, mark up your zones, or go to different charts, mark up different zones, and you have to practice. That's the main point. I see far too many people that want to learn a different skill set, any skill set in general, and all they do is consume content. They're not actually taking action. Doing so is called being in mental momentum. They say the most expensive country, the most expensive nation in the world is procrastination. So you don't want to procrastinate. You want to make sure that you're actually doing what you have to do, practicing, and not just practicing. You want to make sure that you're actually inputting trades on your account. If for whatever reason you're too nervous or scared or not confident enough to enter trades on a live account, do a demo account. And if for whatever reason, and I've seen people tell me this, if for whatever reason you're even still nervous to enter trades on a demo account, do it anyways, but put your lot size to 0.01. Just do the lowest lot size you possibly can, because this way, if you lose a trade, you're only going to lose like 1 cent, or like 5 cents, 10 cents. If you win the trade, you're not going to make any money either. It's like 5 cent, 10 cent trades. But the point is to gain the confidence enough to be able to do this very easily without struggling or being uncomfortable. And then once you gain the confidence, you can then start increasing the lot size. But hopefully this was able to at least get you started, get you in a position where you're doing things super simple, not too complicated. This right here can get you in a position where you are having a positive expectancy, you are profitable. Now, we do have a private program where we go a little bit more into details and helps our traders identify areas that are a little bit higher probability, maybe avoid trades that otherwise would have been a losing trade, and just get that 50% win rate just higher and higher and higher, so you can optimize your trading strategy to get the highest risk to reward ratio and highest win rate as you possibly can. So if you do want a little bit more information about that, there's a link in the description for our private mentorship program. You can go and check that out as well. But that being said, if you enjoyed the video, leave a like. It genuinely, truly does help out the channel. Share this video with another trading buddy that you're trading with. And if you have a comment down below of any other video ideas that you want me to do, feel free to comment down below and I'll be more than happy to make videos regarding whatever topics that you guys suggest. That being said, take care and I'll catch you guys in the next video.